Uganda Revenue Authority's collections for the 6 months from July to December 2019 fell short of the target by at least 697.4 billion shillings. Government has revealed it will be forced to borrow 2.4 trillion shillings from commercial banks to plug the revenue shortfall gap. Despite these challenges, Uganda is giving away tax incentives. In the last financial year, government doled out an astronomical 1.4 trillion shillings in tax exemptions and incentives to select companies. If put to proper use, 1.4 trillion shillings can construct 2,800 modern health center 3s in the remote islands of Kalangala, where many pregnant women can hardly afford transport on rickety canoes to find a safe place to deliver. At a cost of about 500 million shillings, each of the health center 3s should have a children, male and female wards having 50 beds. For a country with one of the lowest tax to GDP ratios in the region, there is cogent evidence to suggest that some of these exemptions, granted arbitrarily, do not have any tangible benefits to the economy. Many of the incentives are provided for in the law and are offered to domestic and foreign investors. The exponents of the incentives claim they have boosted growth in the hotel industry, offered employment, driven exports, and driven growth in backwaters like Kalangala and Kapeka. Many countries offer incentives to attract investment.
When you look at BIDCO, they wanted more incentives than they were in the law because of what they were going to do in Kalangala. Nobody could have undertaken such a project of enormous risk and finances without some sort of incentives. We did a study which showed that there was need for government involvement in terms of either of giving cash or giving tax holidays for this project to be viable. And because of that, we agreed to give them incentives.
It's about the way the tax exemptions are given. There are statutory regulations of how tax exemptions should be given, but sometimes most of the exemptions are given through executive orders. That one don't pay tax, that one government will pay on their behalf.
Under the Income Tax Act, there are a number of exemption regimes which are granted. For instance, a person or company that exports at least 80% of his consumer and capital goods, a person who derives income from agro-processing qualifies under this fiscal policy scheme. Section 21(1) of the Income Tax Act sets stringent conditions that one ought to fulfill before the exemptions can be granted. Amongst them is the export documents, records of goods that have been produced, records of goods that have been warehoused, schedule of export sales, schedule of local sales, export license, records of inputs used in goods produced. But fears abound that many of the companies granted these exemptions did not meet these requirements. The process of approving exemptions and incentives is under the supervision of the Finance Ministry. Parliament only finds out which companies have been granted exemptions when a supplementary budget is tabled. In the financial year 2016-2017, the House Budget Committee withheld the approval of a supplementary budget of 16 billion shillings as a tax exemption. Lawmakers on the Budget Committee also questioned the staggering expenditure of 47 billion shillings, which they claim was illegally granted as exemptions in the same financial year. The committee observed that the government, in perpetrating the tax expenditure policy to support investment in strategic areas, executed certain documents to exempt some companies from certain tax obligations. The committee scrutinized the documents and noted that the majority did not meet the requirements of the law, reads the statement from the Budget Committee. With such unfettered controls on the grant of exemptions, MPs on the committee have asked URA to recover 47 billion shillings from these farms. Amongst the companies blacklisted to refund the money was Aya Investment to the tune of 3.7 billion shillings as import taxes. URA was meant to deduct 5.8 billion shillings in corporation tax from Bidco, as well as 1.5 billion shillings corporation tax from Steel and Tube Industries Limited. The tax body was meant to deduct 6.7 billion shillings as import tax from Southern Range Nyanza, bringing the total to 47 billion shillings. It's not clear yet whether these deductions were enforced. In the last financial year, SGI Studio Gali Consultancy received 1.2 billion shillings in exemptions. Arab contractors received 28.33 billion shillings. Rocco Construction received 10.8 billion shillings. Uganda Cement received 9.2 billion shillings. Nippon Parts received 2.8 billion shillings. Steel and Tube Industries Limited received 20 billion shillings. Cipla Quality Chemicals got 57 billion shillings. Oil Palm Uganda Kalangala received 134.7 billion shillings. Southern Range Limited received 86.8 billion shillings, and the Ministry of Finance received 86.8 billion shillings. Others that received exemptions include Lily Benefits Center, which got 2.3 billion shillings, and Office of the Prime Minister that benefited from a shillings 29 billion exemption. Despite the warning from the Budget Committee, it's not clear why Steel and Tube Industries, as well as Southern Range Nyanza, received a total of 100.8 billion shillings after being blacklisted in the 2017-2018 financial year. There is a view that some of these exemptions are hurting the local industries and advantage foreign firms cherry-picked to benefit from the waivers.
The controversies around exemptions in Uganda are related to the divide between FDI and DDI, foreign direct investment and domestic direct investment. So you will go to some construction companies and you'll notice that their equipment and vehicles enter tax-free. And then for the local construction companies, it may not be the case.
Investors in quotes. Some people are benefited from these tax holidays, some people are benefited from these exemptions, but they are still a problem to this country. But if it was done well, it wouldn't be a problem because it's within the law. It's not outside the law. It's only the procedure that may be circumnavigating the law, because there is a procedure to be followed for which people are exempted, for which people are given what? Holidays.
For instance, Sembule Group of Companies was once the pulse of an economic miracle in the 1990s as the regime embraced free market policies under the World Bank-led neoliberal reforms. The group, which had a steel factory, also had Sembule Investment Bank, an insurance firm, Palmworld Insurance, and a television radio assembling plant and energy-saving bulbs. But Sembule became a symbol of the fleeting success of blue-chip companies that failed to adhere to the stringent rules of financial discipline and prudence. As sales cratered and the firm saddled with a debt of 27 billion shillings teetered towards collapse, the owners made one last desperate bailout call, but government withered on the vine. In 2014, the motors that once roared at the steel factory went silent as the company fell under the hammer.
Our government should always come back and give the local investors the first priority.
Some of these firms which are receiving exemptions are domiciled in countries which are secrecy havens and have low tax jurisdictions, where companies also rely on transfer pricing to shift profits between entities where they only exist on paper. This engenders inequality and unfair competition. Agreements in which these exemptions are granted are not traceable, but also a majority of the beneficiaries do not furnish this information to URA in their tax returns.
Checks and balances are there, they are there, but you know what they call collusion? I'm an accountant. Collusion is where people coordinate to beat the what? The checks. They coordinate, they connive to beat the checks. Corruption is involved. It's out of control. You know what corruption is? Corruption is between the giver and the taker. If the two sit down and agree on what they want to do, there's nothing you can do because nobody reports until you catch somebody doing the bad thing. That's what we're saying. As Parliament, we set the laws. But later we also look at how the money was spent. But it's already gone.
I'll give you an example. One of the avenues and the routes that the companies exploit is through declaring what you call some of the products as raw materials. But in the end, that is a product that is going to be put on the market for consumption. But because there is a different tax rate for raw material, for instance, a company will import a steel rod and they will declare that that is raw material for making, for instance, iron sheets. But the same steel rod will just be melted and iron bars will be made out of it, or will be directly sold to another company as a product.
And officers from maybe the Revenue Authority also agree that these things are raw materials, when actually they know that they are finished. So how will they look at such a person?
But is there a careful study based on compelling reasons to give incentives and exemptions? Could it be premised on job creation, the production of scarce commodities, import substitution, or the ability to support a nascent domestic industry?
Uganda needs to define through a clear policy framework what are the areas, which areas do we feel we might need tax incentives or holidays. And that must be based on research, and then we should be sure and monitor annually the return that we get on the incentives we are giving. So for instance, if you are giving incentives based on the expectation that we are going to get jobs, can we define how many jobs we expect to get a return?
There are some good practices. For example, there's a law on special economic zones and free zones that are meant to deal with industrial production and exports. And there the exemptions are quite clear for companies that will be exporting more than 80% of their produce. So the criteria is well known and it's quite clear. That's probably the best way to give exemption.
At Palm Oil Uganda Limited, an edible oil refinery farm, it's a mixed bag for workers who are employed by the company, which is a recipient of tax exemptions. Palm Oil Uganda Limited has over 1,200 Ugandan employees.
Ku bye tukozesa omuli gumboots, element, gloves, wheelbarrow, hook, kizo, siko. Byandibadde batugamba nti bya bwereere, naye ate ebiseera ebimu twesanga nga ffe abakozi tunyigirizibwa nti lwaki ekintu kye bakuwadde mu kusooka kijja kaddiwa nga kikaddiridde ku mulimu. Bwe ngenda eri nga supervisor atutwala ne mugamba mukulu Wiriba nti siko siina oba yakutuse, anziramu n'aŋŋamba nti no, olina okweyiya ogule osobole okutereeza omulimu gwa mukama waffe. Naye ng'ate kyaŋŋamba okugula kiri expensive, nze ng'omukozi sikisobola.
I can assure you we have done some investigations. There are some companies here, steel companies, when you go at the type of employment they are giving, the quality of employment, you will not have anybody, no single worker, apart from those that are top management, has a permanent contract. So they are given a week contract. Is that the type of jobs that we expect to get when we give some of these incentives? So no investigation has been done. There are companies that have been given 20 years of tax holidays in this country. But when you look at the people they are employing, they are charging them from a gumboot to the food they are eating, everything. And they are being paid the lowest wage you can imagine in Uganda. And we have also given them land in addition, and we have also given them tax holidays. So we think we are bleeding the country of its resources and we are not getting as much from these tax incentives.
In giving exemptions, government expects to attract investors, investors who create maybe industries, create jobs, increase productions and grow the economy. We have done a lot of researches and that doesn't happen. So when you look at how much we pay and how much we are getting, it doesn't balance.
The Oversight Public Accounts Committee wants government to renegotiate the 16-year tax exemption contract with Palm Oil Uganda Limited. Currently, government owes the company 64.7 billion shillings in arrears after it failed to honor one of the conditions of the agreement, which required that it provides another 10,000 hectares of land for palm oil growing.
Even if the quantity of land that was negotiated with the government of Uganda was not availed, the oil production has started, it means we have nothing to do with in terms of taxation with the oil company. So why should the oil company first come and say, well, if you don't guarantee us this amount of land, then we are not going to start production. And yet they have started production. So here is a situation where, as members of PAC, we thought the government should renegotiate based on the production level of the issue of oil palm. If you went to Kalangala now, the whole area is actually covered with this palm oil. And then there is production going on. They are selling oil. And yet we are not allowed to tax them. Because the MOU stipulates that until the government fulfills the availability of land, which was supposed to be given to the oil palm industry, there is no taxation, there is no business. And these people are doing business. So this deal has to be renegotiated so that we get the best out of what is going on now in Kalangala and in Buvuma Island.
Those agreements have some terms and conditions. So it becomes difficult to all of a sudden terminate the part of the terms in the agreement. We may not necessarily discuss those terms here, but BIDICO as a company can be talked about. Why is it benefiting from this? But we agreed with BIDICO on principle that please come to Kalangala, grow for us this, set up a factory, make this, employ people, boost people. Then in turn, we are going to offer you land, we are going to offer you this, we are going to give you an exemption for this period of time. How do you turn around and jump on the way? It still goes back to the question you asked me. How did you negotiate in the beginning? Were you genuine? Were you bought off? That is the biggest problem we have. Because now we're complaining, the thing is in black and white.
The Acting Director, Economic Affairs in the Finance Ministry, Moses Kagwa, revealed that government largely provides tax incentives and holidays to improve Uganda's investment climate and exports abroad.
So we are encouraging companies to invest in this country, and also we are encouraging them to export. When you look at our agriculture sector, it's about 24.5% of GDP. It employs over 80% of our people, and the 60% households which are in subsistence are in agriculture. So you need to incentivize the private sector to come into agriculture and make sure that they participate in the entire value chain.
He also cited strategic investments such as CIPLA quality chemicals and Oil Palm Uganda that qualify for incentives even when they're outside the ambit of the law. CIPLA quality chemicals last week announced a loss of 14.5 billion shillings for the period from April to September 2019. The company, which is listed on Uganda's stock exchange, attributed the loss on failure to collect debts from the government of Zambia, increased competition from other companies that produce similar products, and reduction in drug prices. The consequences of such exemptions are dire. A lot of revenue leakages are through tax exemptions and incentives. Statistics from the World Bank show a stagnation of Uganda's tax to GDP ratio at about 11% over the last 10 years. In comparison with regional neighbors, Uganda's tax revenue to GDP is still below the 16% sub-Saharan average and lags behind her EAC neighbors too.
The whole issue about tax is about having compliance and administration. Of course, you have to understand that the government is a bit under pressure in terms of the fact that when you compare the yield of the tax, as in the percentage of tax to GDP, is a bit below our neighbors. So the question is always whether it's the tax policy that is the problem or the tax administration that is the problem. The administrators are URA and the policies are the Minister of Finance. So the Minister of Finance has tried to capture what it calls the informal sector through the mobile money tax.
A 2012 study on tax incentives in East Africa found that the countries were in a race to the bottom. The report noted that all the evidence suggests that the disadvantages of tax incentives vastly outweigh the advantages and that such incentives are not needed to attract foreign direct investment. They also attract footloose companies that pack up when the incentives expire or reduce and lack transparency, and hence increasing the likelihood of corruption.
Research estimates that annually we are losing close to 1 trillion Uganda shillings in tax exemptions and giveaway. 1 trillion. Now, our budget, if you look at it, is about 34, and so that is a significant share of the revenue that we are losing. And I want to tell you that is on the conservative scale. So if we document it thoroughly, we are sure that the tax expenditure we are carrying as a country must be way higher than even what we have documented.
In chicken and egg, which comes first? If you want investments, how do you bring them into the country? Because if you don't have the investments, then you won't have the revenue. So we have to balance both and say, well, we are going to forfeit money today. We are not going to eat the egg today and wait until we have the chicken. When the investments are finally here and they have developed, they are not going to go away, because if somebody puts up a hotel like Serena, it's not going to take it away tomorrow. It will be here forever. But at least if you have lured him to come and invest in your country with these incentives and he comes, that is good for the economy.
Experts suggest the need to shift towards diversification. For instance, Kenya provides tax incentives to companies that list on its stock exchange, and the UK grants exemptions to firms that are compliant in remitting taxes.
I know England is very far away from here. They had a tax regime which would give an automatic break to all small companies that would reach a turnover of about £100,000, which would be about 400 million.
Is it the case here?
No, it's not the case here. So what that did is that the small companies always aspired to be compliant and to reach that level.
Can we convert the tax giveaway into shares that Ugandans can own? If you are giving a company a tax holiday worth 1 trillion, can we convert that into shareholding for Uganda, so that Ugandans at the end of the day can benefit as shareholders in the company instead of just giving it as a tax giveaway? So these are some of the proposals we have made to government for consideration. And I think the starting point is that the Auditor General should take a thorough audit to ensure that the tax expenditures we have incurred as a country are thoroughly documented and quantified.
Civil society should be to advocate, to be able to engage members of parliament, engage finance, to be able to put strict laws in place. But we also need to monitor, how many companies are being given tax exemptions, where they given those tax exemptions in the right way or not, what are we benefiting, so that there is a public debate.
Experts believe that government should prefer statutory exemptions over arbitrary exemptions, and the criteria should be made clear and subjected to scrutiny. They also recommend that companies that don't file tax returns should face harsh penalties and should not be granted exemptions. If incentives are granted arbitrarily, Such system of discretionary tax waivers interferes with the free market by distorting it and creating unfair competition, which favors the beneficiaries of the incentive policy at the expense of others.